Hey everyone, welcome back to the channel. It feels like every time you turn on the news, there's another warning sign flashing. Some experts are saying this could be even bigger than what we saw in 2008. So, let's break it down, look at the evidence, and figure out what's really going on with the global economy. First, let's talk about the big player in the room, the Federal Reserve. Over the past couple of years, the Fed has been on a mission, aggressively hiking interest rates to combat soaring inflation. Now, what does that actually mean for you and me? When the Fed raises rates, it becomes more expensive for everyone to borrow money. Think about mortgages, car loans, and credit card debt. The interest you pay on all of those goes up. The idea is to cool down the economy, to get people and businesses to spend less, which should, in theory, bring prices back under control. The problem is, it's a very blunt instrument. While they're trying to put the brakes on inflation, they might be slamming them too hard and sending the economy into a full-blown recession. We've seen the fastest rate hiking cycle in decades, and the full effects of these hikes often take a year or more to ripple through the entire system. It's like turning a giant ship. It doesn't happen instantly. So, while inflation has come down from its peak, the cost of that has been a significant slowdown in economic activity. Businesses are thinking twice about expanding, and consumers are definitely feeling the pinch. And that brings us to inflation itself. We've all felt it at the grocery store, at the gas pump, and when paying our rent. For a while there, prices were rising at a pace we hadn't seen in 40 years. Your paycheck just doesn't stretch as far as it used to. This erosion of purchasing power is a huge deal. It puts immense pressure on household budgets, especially for low and middle-income families. People are having to make tough choices between essentials, and savings are being depleted just to cover daily expenses. When a large part of the population is struggling just to get by, it creates a massive drag on the entire economy. Consumer spending is the engine of our economy, and when that engine sputters, we all feel it. Now, let's layer on another massive problem: debt. We are currently sitting on record levels of debt, both for households and corporations. It's staggering. U.S. household debt has surpassed $17 trillion. That includes mortgages, auto loans, credit card debt, and student loans. For a long time, ultra-low interest rates made this debt manageable. But now, with rates going up, the cost of servicing that debt is exploding. People who took out adjustable rate mortgages or have large credit card balances are seeing their monthly payments skyrocket. This can easily lead to a wave of defaults, which would put immense pressure on the banking system. It's not just households either. Corporate debt is also at an all-time high. During the era of cheap money, companies borrowed heavily. Some used it to invest and grow, which is great, but many used it for things like stock buybacks, which boosts the share price in the short term but doesn't create long-term value. Now, they're faced with refinancing all that debt at much higher interest rates. This is where we get the scary concept of zombie companies. These are businesses that don't earn enough profit to even cover the interest payments on their debt. They're basically walking financial corpses, kept alive only by their ability to keep borrowing more money. With interest rates now much higher, that lifeline is being cut. We could see a wave of corporate bankruptcies as these zombie companies finally collapse, leading to job losses and further economic turmoil. Okay, so what about the housing market? This is often the canary in the coal mine, and everyone remembers how the housing crash triggered the 2008 crisis. Today's situation is complicated. On one hand, housing prices are still incredibly high in many areas, and affordability is at an all-time low thanks to the combination of high prices and high mortgage rates. A 30-year fixed-rate mortgage has more than doubled in a short period. This has priced a huge number of potential buyers out of the market. Activity has slowed to a crawl. However, there are some key differences from 2008. Back then, the market was flooded with risky, subprime loans given to people with no real ability to repay them. Lending standards today are much stricter. Most homeowners have stable, fixed-rate mortgages and a good amount of equity in their homes. So, we're less likely to see the same kind of foreclosure crisis that we saw in 2008. But that doesn't mean the housing market is safe. A significant drop in prices could still have a major psychological impact, destroying household wealth and causing people to pull back on spending, which again, slows down the whole economy. The commercial real estate sector is a whole other story, with office buildings sitting empty in major cities, which could trigger its own localized crisis for regional banks. When you mix high inflation with a slowing economy, you get the dreaded stagflation. This is the worst of both worlds. It's when you have stagnant economic growth, or even a recession, combined with persistently high inflation, your wallet is getting hit from both sides. Prices are high, and job security is low. This is a policymaker's nightmare because the tools to fight inflation, like raising interest rates, make the recession worse. And the tools to fight a recession, like cutting interest rates and stimulating the economy, make inflation worse. It's a trap, and it's a very real risk we're facing right now. We could be heading into a prolonged period of economic malaise, where things just feel sluggish and difficult for a long time. But wait, there's more. Hiding in the shadows is the private credit market. This is a massive, multi-trillion-dollar market where loans are made to companies directly by investment funds, not by traditional banks. It's often called shadow banking because it's much less regulated and far less transparent. As banks have pulled back on lending due to stricter regulations post-2008, this private market has exploded in size. The danger here is that nobody really knows the true extent of the risk. Who holds this debt? How risky are the loans? If a wave of defaults were to happen in this opaque market, the contagion could spread rapidly and unpredictably through the financial system, catching everyone by surprise. It's a huge unknown, and in finance, unknowns are what cause panics. On top of all these financial pressures, we have a world that feels more unstable than it has in decades. Geopolitical tensions are running high everywhere. Conflicts and trade disputes create uncertainty, disrupt supply chains, and can cause sudden spikes in the prices of essential commodities like oil and food. This adds another layer of inflationary pressure and economic risk that is completely out of the control of central bankers. A major escalation in any of these global hotspots could be the spark that ignites the whole fragile system. Finally, let's look at the job market. For a while, it was the one bright spot. But now, we're starting to see cracks appear. We're hearing more and more stories about job offers being rescinded. Companies are hiring someone, giving them a start date, and then calling them back to say, sorry, the position has been eliminated. This is a huge red flag. It shows that companies are getting very nervous about the future and are slamming the brakes on hiring plans. Mass layoffs in the tech sector were just the beginning. If this trend spreads to other sectors and unemployment starts to rise significantly, it will be the final nail in the coffin for consumer spending and could push us decisively into a recession. So, when you put it all together, the Fed's rate hikes, persistent inflation, record-breaking debt, zombie companies, a teetering housing market, the risk of stagflation, a shadowy private credit market, geopolitical turmoil, and a weakening job market, the picture looks pretty grim. It feels like we are navigating a minefield. Any one of these factors could be the trigger for a major crisis. This isn't to say a crash is guaranteed, but the risks are undeniably high. It's more important than ever to be informed, to be prepared, and to make smart financial decisions. Look at your own budget, manage your debt carefully, and maybe think about building up an emergency fund. I know this is a lot to take in, and it can feel overwhelming, but understanding these dynamics is the first step toward navigating whatever comes next. Thanks so much for watching. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into the economy. I'd love to hear your thoughts in the comments below. Are you worried? What are you seeing in your own life? Let's continue the conversation down there. Stay safe, and I'll see you in the next video.